What if I told you the traditional entry-level accounting job? I mean, the exact one that you and I both ground our teeth on, the one built on just endless data entry and those late-night bank reconciliations. What if I said that will effectively cease to exist in about 24 months?
Honestly, I would argue it's already happening
Right.
right now.
Yeah.
Oh, absolutely. The bottom rungs of that traditional professional ladder aren't just breaking, they're evaporating into the cloud. And it's leaving a lot of firm owners just staring at this massive structural gap in their daily operations.
Well, welcome to the deep dive. Today we are speaking directly to you, the professional, the CPA, the partner, really the small firm owner with anywhere from, say, 1 to 20 staff members. Because you are the ones feeling the absolute heaviest gravity of the modern accounting landscape right now.
Yeah, the pressure is incredibly real at that size.
Exactly. And so today, we're taking a highly targeted stack of industry intelligence. We're drawing from hard data and use cases published by Accounting Today, the Journal of Accountancy, plus some direct operational metrics from platforms like Botkeeper, Vic.ai, Intuit, and a few others. And we're using all of that to look at a very specific phenomenon.
Right, we are dissecting the 7 specific AI tools that are actively replacing the junior accountant as we speak.
Right.
But, and this is crucial, we need to define our terms immediately.
Right. No hypes today.
Exactly. This is not a hype session. We're not talking about, artificial general intelligence waking up and deciding to become a CPA.
Thank goodness.
Right. We are looking at the concrete, buzzword-free mechanics of what these specific tools actually replace in a real day-to-day accounting workflow.
And that is the core mission here. We really want to cut through all that marketing noise. Because, look, you don't have time to hear someone wave their hands and yell revolutionary. You just don't. We're going to look at how these algorithms are actually combating things like client volume growth, escalating staff costs, brutal deadline pressures,
And that ever-growing compliance burden, which is just massive.
Yes, exactly. We're going to look at how the technology actually functions under the hood, what its genuine limitations are, and what a smart firm owner is doing about it right now to protect their margins.
So let's start by looking at the actual environment that's forcing this adoption.
Yeah.
Because the data we are seeing in the Journal of Accountancy, it paints a fairly brutal picture of the economics of a 1 to 20 person firm today.
It really does.
The traditional business model of a CPA firm was always this pyramid of leverage.
Right. So the partner sits at the top. They're bringing in the clients, doing the high-level review, maybe playing some golf.
Hopefully playing some golf.
Right. And to service those clients, the partner hires a layer of managers, and beneath them, this massive wide base of junior accountants and bookkeepers. And you bill out the juniors' time at a multiple of what you actually pay them. I mean, that was the formula for wealth in this industry for a century.
It was. But look at what is happening to the base of that pyramid today.
Mm.
I mean, if your firm takes on, say, 20 new small business clients, the historical solution was simple. You just hire another junior accountant.
Sure.
But the cost of acquiring, training, and retaining that entry-level human has just skyrocketed. Starting salaries are up dramatically.
Yeah.
Benefit costs are way up. And simultaneously, the pipeline of accounting graduates who are actually willing to sit in a cubicle and do 60 hours a week of manual data entry during tax season.
Yeah, that pipeline is shrinking rapidly. People just don't want to do that grind anymore.
No, they don't. So the margins just evaporate.
Right, because if I hire a junior at today's market rate just to do basic data entry, my profit on those 20 new clients is essentially zero. I'm taking on more risk, more management headaches, more overhead, literally just to break even.
Which forces the firm into a corner. You either stop growing or you raise your fees so high that you risk losing your clients, or, and this is the tipping point for 2025, you change the fundamental architecture of how the work gets done.
Okay, let's unpack this a little. Because when we say these 7 tools are replacing the junior accountant, we hear a lot of noise about AI, but we have to be highly specific here. We do not mean the entry-level job is dead, right?
Right.
Or that humans will never enter the profession again.
No, we mean the entry-level tasks are dead.
Okay, so are we talking about something like the transition from physical ledgers to Excel? Because, when spreadsheets became ubiquitous, the work of accounting didn't disappear. The baseline just shifted. You no longer paid someone simply because they had legible handwriting and could operate a mechanical adding machine.
It is a similar shift, yeah. But the velocity is entirely different this time. I mean, Excel made the human faster at calculating. AI makes the human unnecessary for the assembly of the data in the first place.
Oh, wow. Okay.
Yeah. The grunt work evolved from adding columns of numbers by hand to building VLOOKUP formulas in Excel. And now the grunt work of building that formula and manually mapping the data that's evolving into managing an algorithm that maps the data autonomously.
And if you add in the compliance and deadline pressures to that, I mean, the fact that state-by-state nexus rules have just exploded in complexity while the tax deadlines remain completely rigid, you start to see why throwing an exhausted, expensive, and let's face it, inexperienced human at a growing pile of compliance work is just a recipe for professional liability.
Exactly. You cannot solve a 2025 margin and complexity problem with a 1995 staffing model. It just will not hold. So to solve this bottleneck, you have to look at the anatomy of the workflow itself. And every workflow in accounting begins at the exact same bottleneck, getting raw, unstructured real-world data into a structured digital system.
Ah, yes. The dreaded client shoebox.
The shoebox.
I mean, the crumpled up Home Depot receipts covered in coffee stains, the faded thermal paper from some random gas station, or, the forward of an email with a weird PDF attached. If you don't have the data, you can't reconcile the books, you can't run advisory reports, and you certainly cannot file an accurate tax return.
Right. It's the immutable law of accounting. Garbage in, garbage out. Or, more commonly in this case, nothing in, nothing out.
Yeah.
Historically, a junior accountant would spend hours literally smoothing out those crumpled thermal receipts so they could go through a physical scanner. Then they'd sit at a dual monitor setup, looking at a PDF on the left screen and manually typing the date, the vendor name, the line items, and the tax amounts into a general ledger on the right screen.
It is soul-crushing work. I remember doing it. Your eyes just glaze over. And, you transpose a 6 and a 9, and suddenly your end-of-month reconciliation is off by 30 cents.
And you spend 2 hours hunting down your own typo.
Exactly. So the first tool in our stack, Dext, which a lot of firm owners might actually remember under its old name, Receipt Bank. It attacks this specific choke point. But how does it actually do it better than the legacy software we've had for a decade? Because we've had optical character recognition, or ACR, for a long time.
We have. But legacy OCR was rules-based, and it was deeply fragile. It essentially looked for coordinates on a page. It was programmed to think, okay, the total amount is usually in the bottom right corner.
Right.
But if a client wrote the tip on a restaurant receipt in blue pen, or if the receipt was photographed at a weird angle or upside down, the legacy OCR would just fail, and a human had to intervene. Dext replaces that fragile rules-based system with computer vision and machine learning.
Meaning it actually understands context.
Precisely. It doesn't look for coordinates. It uses semantic understanding to know that a string of numbers next to the word total, or amped, represents the final charge, regardless of where it is on that crumpled piece of paper. It instantly extracts that data from a smartphone photo or a forwarded email, digitizes it, and pushes it directly into the ledger. But more importantly, it predicts the categorization based on past behavior and millions of other data points.
So if a solo CPA is listening to this, and they've got a roster of, say, construction clients, plumbers, restaurateurs, basically people who generate massive amounts of physical, dirty receipts, Dext is basically an automated data entry clerk working 24/7.
Yes, it is the automation of the first mile of accounting. If you can digitize the first mile without human intervention, the rest of the workflow accelerates exponentially. I mean, it is an absolute lifeline for solo practitioners and micro firms of 2 to 5 people who are just drowning in messy records and simply do not have the budget to hire an administrative assistant just to chase paper.
Wait, let me stop you there, because we did promise to look at the honest limitations of all this. Fair.
If my client is a plumber who throws every receipt into the glove box of his Ford F-150 and absolutely refuses to open the Dext app on his phone, the AI is entirely useless, right? Like, it can't magically beam the receipt out of his truck.
That is the hard boundary of this technology. It remains 100% reliant on human behavior. You are essentially shifting the burden of data capture from your junior accountant over to your client. The AI is brilliant, but it requires the client to at least snap the photo or forward the email. If they starve the system of input, the system dies.
Which means the firm owner kind of has to become a behavioral psychologist, just constantly retraining their clients. Like, no app, no accounting.
Pretty much.
But let's scale this up a bit, because Dext is great for the $40 lunch receipt. What happens when we are dealing with a mid-sized client? Say, a manufacturing company receiving 500 highly complex vendor invoices a month for raw materials, inventory, and specialized services. You can't just snap a picture of a 40-page invoice and call it a day. You cannot. And that brings us to the second tool, addressing this input layer, Vic.ai. If Dext is for the crumpled receipt, Vic.ai is an enterprise-grade engine built specifically for complex accounts payable processing.
Because AP isn't just data entry, it's matching, right? I mean, in a traditional setup, an AP clerk doesn't just type in the amount. When an invoice comes in from a vendor, that clerk has to find the original purchase order. Then they have to find the receiving document to prove the goods actually showed up, the classic three-way match.
Exactly. And beyond the matching, there is the cognitive load of coding the ledger. The clerk has to look at an invoice from, say, Apex Consulting. And remember, the institutional knowledge of the firm, they have to know, all right, Apex Consulting invoices usually need to be split 60% to the marketing department budget and 40% to IT. And oh, if the total is over $10,000, it has to be routed to Sarah for a physical signature.
Right. That requires a human who has been sitting at that specific desk for 3 years to hold all those invisible rules in their head.
And Vic.ai replaces that specific human. It replaces the dedicated AP data entry clerk and the mid-level routing manager. It uses vector databases and machine learning to ingest the invoice, extract the line items, and autonomously perform that three-way match against the POs in the system. But the real magic is the predictive ledger coding.
How so?
Well, it doesn't use static if-then rules that break the second a vendor changes their invoice format. It looks at the historical patterns of your firm and predicts the departmental splits in GL codes with massive accuracy, and then automatically routes it for approval.
Okay, so it actually learns the institutional knowledge. But let's look at the firm profile here. If I'm a solo CPA doing basic tax returns and bookkeeping for local coffee shops, this sounds like, I don't know, buying a commercial jet to go to the grocery store.
Oh, it would be a catastrophic waste of money for a solo CPA. Absolutely.
Mm-hmm.
Vic.ai is built for firms with roughly 10 to 20 staff members that are handling outsourced accounting, fractional CFO services, or just highly complex AP for larger mid-market clients. It is for firms where the sheer volume of vendor invoices is creating a bottleneck that prevents the firm from taking on larger, more lucrative clients.
But isn't there a massive silo issue here? It sounds like a sports car that can only turn left. Like, it solves accounts payable brilliantly, but it doesn't touch accounts receivable. It doesn't manage the overarching ledger. It doesn't prepare taxes.
You are identifying the fragmented reality of the current AI landscape. We do not have one monolithic AI that does everything. Vic.ai is deeply specialized. It is a single-purpose engine. You deploy it to eliminate the specific AP bottleneck, but you have to integrate it with the rest of your tech stack. It will not balance your books on its own.
Which is the perfect segue to the actual processing of the data. Right, so the raw data has been captured by Dext and Vic.ai. The first mile is done. Now that data has to be organized, categorized, and most importantly, reconciled against the bank feeds. We are moving from the data input layer to the processing engine. And the industry intelligence points heavily toward two major platforms here, Botkeeper and Intuit Assist.
Yes, and this is where the structural earthquake really hits the traditional accounting model, because this is where we see the most dramatic, quantifiable reduction in raw human hours. Let's look at Botkeeper. It is fundamentally focused on automated bookkeeping and bank reconciliation.
Okay, let's talk about the specific statistic highlighted in the sources because it completely stopped me in my tracks. Firms using Botkeeper report cutting their bank reconciliation time from 40 hours a month down to under 5 hours.
It's staggering.
I mean, 40 down to 5. That is almost an entire week of a human being's life given back to the firm every single month.
To truly understand the gravity of that, we have to look at the mechanics of a traditional month-end close. Think about what a junior accountant actually does on, say, the fourth day of the month. They export the bank statement as a massive CSV file. They open the general ledger in another window, and they sit there line by line, playing a giant, anxiety-inducing game of memory matching.
Right. Building VLOOKUPs that inevitably break because the bank uses a slightly different text string than the accounting software. Or, the dates don't match because the credit card processor delayed a batch by 36 hours over a holiday weekend. You have two massive columns of numbers, and you are just hunting for the exceptions.
It is the definition of high-friction, low-value work. Botkeeper injects machine learning directly into that matching process. Because it has analyzed the transactional patterns of millions of businesses across its entire network, it doesn't rely on a junior accountant to guess what a charge is. It uses anomaly detection algorithms to confidently categorize and match the vast majority of those transactions autonomously, overnight, without any human intervention.
But hold on, how does the AI actually know the difference between, say, a $400 charge at Home Depot that should be coded as a routine office maintenance expense versus a $400 charge at Home Depot that a contractor client wants coded as cost of goods sold for a specific job site?
And that is the difference between rules and probabilistic learning. A rules-based system would just see Home Depot and dump it all in one bucket. Boom, office supplies. Botkeeper's machine learning looks at the contextual metadata. It looks at the specific client's historical behavior, the behavior of similar clients in that specific industry, the frequency of the purchase, and the surrounding transactions. It makes a highly educated, probabilistic match. And if the confidence score of that match falls below a certain threshold,
It flags it.
exactly, it flags it for human review. And this brings us to the profound psychological barrier of adopting a tool like this. The limitation of Botkeeper isn't necessarily technical, it's cultural. It requires the firm partner or the senior manager to give up the illusion of absolute granular control.
The anxiety of the black box.
It is a massive hurdle.
Oh.
I mean, for a CPA who spent 20 years trained to tie out every single penny manually, to cross every T and dot every I themselves, trusting an algorithm to do 95% of the work unseen is deeply uncomfortable. You are no longer checking every line to ensure accuracy. You have to shift your entire operational mindset to managing the exceptions. You only look at the anomalies, the machine flags.
Which completely changes the profile of the firm that should adopt this. If you are a solo CPA doing 20 simple tax returns, this is overkill. But if you are a growing firm, say 5 to 20 staff, and you are aggressively trying to scale your client advisory services or CAS division, this is the engine. You are taking on 50 new bookkeeping clients, but you absolutely cannot afford the fixed payroll cost of hiring 3 new junior accountants to do the reconciliation. You deploy Botkeeper to scale the software, not the headcount.
But we must address the critical counterargument here. If Botkeeper is magically doing 35 hours of reconciliation work overnight, what is the accountant actually doing at those 35 hours?
Right. If you just take those 35 hours and go play golf or scroll social media, your firm isn't actually growing, you're just resting. Which, is fine if lifestyle design is your only goal. But if we are talking about firm economics and surviving that margin squeeze, that saved time is a depreciating asset if you don't reinvest it.
Exactly. The time must be reallocated to interpretation and advisory. The value of the CPA is no longer in the assembly of the historical data. It is in the interpretation of that data for the future of the client's business. You have to take the clean, reconciled books the AI generated, sit down with the business owner, and explain what the cash flow trends actually mean for their hiring plans next quarter. You move from looking in the rearview mirror to looking through the windshield. If a firm uses AI just to do the same old compliance work faster, they are just a highly efficient dinosaur.
Man, that's a great point. Okay, let's look at the other side of the processing engine, because not every firm is going to deploy a massive standalone platform like Botkeeper. The sources highlight Intuit Assist, which represents a completely different philosophy of AI integration.
Right. Intuit Assist is embedded directly into the QuickBooks ecosystem. It is fundamentally different from a plug-in platform. It is bringing large language models Gen AI directly into the software that millions of small businesses and solo practitioners are already living inside every single day.
So what does it actually replace for, say, the solo practitioner?
It replaces the manual generation of insights and reporting. Instead of a bookkeeper spending an hour clicking through menus, exporting tables, and building a custom chart to show a client their revenue trends, you simply prompt the AI in natural language. You literally just type, "Show me the cash flow trend for the last quarter compared to the same period last year," and highlight the 3 largest areas of expense growth. The LLM translates that natural language prompt into a query against the financial database and generates the report instantly.
So it democratizes the capability. If you are a solo independent bookkeeper, you don't need to be a data scientist or buy enterprise software to provide high-level visual reporting to your clients.
Exactly. But the limitation is stark, and it is built right into the business model. It is a walled garden.
Ecosystem lock-in.
Completely.
Yeah.
If your client grows to the point where they need a robust ERP system and they migrate to Oracle NetSuite, or if you acquire a new client who insists on using Xero, this specific AI assistance is entirely cut off. You cannot leverage Intuit Assist outside of Intuit's walls. You are binding your firm's future efficiency to the roadmap of one specific vendor.
Well, let's step back and look at the board then. The data is in via Dext and Vic.ai. The books are reconciled, and the reports are generated by Botkeeper and Intuit Assist. The raw accounting is done. But anyone who has ever worked in a multi-person firm knows that doing the accounting is really only half the battle.
Often it's the easier half.
Right. The real nightmare is managing the work. Dealing with hundreds of clients, massive deadline pressures, different staff members touching the exact same file. The work has to be reviewed, tracked, and pushed through a compliance pipeline without anything falling through the cracks. So we are moving to the management layer. the brain of the operation. And the sources point us directly to Karbon and Canopy.
This operational layer is where firms either scale gracefully or collapse under their own weight. Let's examine Karbon. Our sources define it as workflow automation specifically designed for accounting firms. But to understand its real impact, we have to look at what happens to a firm partner as the firm grows from 5 employees to 15.
They stop doing accounting.
Exactly. The partner accidentally becomes a highly paid, highly stressed traffic cop. They spend their entire day managing the invisible drag of project management.
Oh, let's role play a specific, painful tax season bottleneck. Because I know people listening will feel this in their bones. It's mid-March. A client finally emails over their missing K-1 document, but they don't upload it to a secure portal. They just email it directly to the junior accountant they talked to on the phone last week. But that junior accountant is out sick today. The senior manager is waiting on that K-1 to finalize the return, but doesn't know it arrived. And the partner is getting angry emails from the client asking why the return isn't done. It is pure siloed chaos.
That exact scenario is what destroys firm profitability, because then the partner spends 2 billable hours tracking down an email in a sick employee's inbox. Karbon replaces the need for that entire panic sequence. It replaces the endless Monday morning status update meetings and the frantic emails asking, who has the Johnson file?
So how does it mechanically stop the chaos?
It breaks the silos by centralizing communication and deterministic workflow automation. In Karbon, emails aren't trapped in individual inboxes. They are triaged and associated with the client's global workstream. When that K-1 arrives, the system recognizes the client, tags the document to the specific tax return workflow, sees that the assigned junior is flagged as out of office, and automatically reroutes the task to the next available team member while simultaneously updating the dashboard for the partner and the senior manager.
Wow. So the partner gets this God's eye view of exactly where every single tax return or month-end close is sitting in the pipeline without having to ask a single person.
It is essential for firms with 10 to 20 staff where visibility across multiple team members is the primary bottleneck. However, there is a massive glaring caveat here, a limitation that destroys more software implementations than anything else.
Which is, AI cannot fix a broken process.
I cannot emphasize this enough. If your firm's internal workflows are chaotic, if they're undefined, if the way a tax return gets processed changes depending on which partner is in the office that day, automating those workflows with Karbon will just result in faster, more efficient chaos.
You essentially take a broken assembly line and speed up the conveyor belt. You hit the wall at 100 miles an hour instead of 10.
Exactly. Software requires logic. You must have standardized, ruthlessly documented standard operating procedures, SOPs, before you deploy a tool like Karbon. The software enforces your process. It does not invent the process for you. If you buy Karbon hoping it will magically organize a disorganized firm, you'll just waste thousands of dollars.
Good to know. Now, what about Canopy? The sources highlight Canopy specifically for tax practice management AI. It seems to target a different kind of operational pain entirely.
It does. Because Karbon manages the internal team workflow, Canopy is deeply specialized to manage the external compliance and deadline burden. It addresses the sheer terror of complex jurisdictional tax rules.
Oh, think about a firm managing a mid-sized e-commerce client today. That client might have sales tax nexus in 20 different states, plus federal franchise tax due dates, varying state extension rules, and local jurisdictional filings. Tracking that manually in an Excel spreadsheet or an Outlook calendar is professional malpractice waiting to happen. The risk of missing a filing date and eating a massive penalty for the client is immense.
Yes, and Canopy uses API integrations with state and federal databases, combined with its own AI logic, to autonomously manage that calendar. It replaces the administrative burden of tracking those dates. But more than that, it can automatically draft client communications regarding those specific tax events based on the jurisdictional triggers and track the resolution. It acts as an automated failsafe against human memory.
But again, let's look at the firm profile. If you are a firm that primarily offers fractional CFO work or strictly handles basic bookkeeping for local brick-and-mortar stores with no multi-state tax prep, Canopy is going to be massive overkill.
It would be. You would be paying for a deeply specialized, heavy tax engine that you never turn on. It is built for firms heavily indexed on complex tax preparation, tax resolution, and tax advisory. But both Karbon and Canopy highlight a profound identity shift for the modern CPA.
Right, you are no longer turning the wrench. You are designing the factory.
That is the transition, moving from doing the work to engineering the system that manages the work. For many CPAs who started their firms because they loved the deep, technical, heads-down aspects of accounting, becoming a systems engineer and a project manager is a very painful, uncomfortable transition.
It's a totally different skill set. But even the most beautifully engineered factory in the world stops running if the delivery trucks don't show up. Which brings us to the final piece of the workflow puzzle, the most unpredictable variable in any professional service firm, the client.
The outside world, always the hardest part.
Oh yeah, we are looking at TaxDome and the automation of the client interface. Because you can have Vic.ai, Botkeeper, and Karbon running perfectly in the background, but if the client won't sign the engagement letter, the whole machine just stops.
Let's talk about the specific friction TaxDome removes. It fundamentally replaces the administrative assistant, or, tragically, the CPA themselves billing at $300 an hour, who has to send 5 separate, increasingly desperate follow-up emails begging a client to upload their W-2 or fill out the annual tax organizer.
Right. It automates the nagging.
It uses conditional logic branching to automate the nagging elegantly. When a client enters the portal and checks a box on their digital organizer saying, "Yes, I bought a new house this year," the conditional logic instantly triggers. It automatically adds a requirement for the HUD-1 settlement statement to their portal task list. If the client doesn't upload that document within 72 hours, TaxDome automatically sends a polite email reminder. 2 days later, it sends an SMS text message. It gently, persistently herds the client toward completion without a human at the firm ever having to draft an email or check a status.
I mean, for a solo CPA or a micro firm of 2 to 5 staff that doesn't have a dedicated admin, that is life-changing. Every hour you spend writing an email saying, "Hey, Bob, still need those bank statements," is an hour you aren't doing billable advisory work.
It is a non-negotiable necessity for small firms. But we must confront the reality of human psychology here. The fundamental limitation of TaxDome, or any client-facing portal, is that it is 100% reliant on client technology adoption.
And we all have that client.
Right.
The 75-year-old legacy client who has been with the firm for 30 years. They hate passwords. They refuse to use two-factor authentication. They think the cloud is a weather phenomenon. And they insist on dropping off a paper bag of unsorted receipts at your front desk every April 2nd.
Exactly. If the client refuses to play the game, the AI document collection completely breaks down. The software cannot force compliance on an unwilling user, which highlights a reality that SaaS vendors rarely discuss. Modern accounting firms need to train their clients just as aggressively as they train their staff.
You have to engage in intense boundary setting. You almost have to put technology compliance right into your engagement letters. Like, "We would love to manage your taxes, but as a condition of our service, you must use this portal."
And that level of boundary setting terrifies many small firm owners because they operate from a place of scarcity. They are terrified of losing the client if they introduce any friction.
Which is the perfect bridge to the existential question hovering over this entire deep dive. We have walked through the entire life cycle of a modern firm. The data input layer with Dext and Vic.ai, the processing engine of Botkeeper and Intuit Assist, the operational brains of Karbon and Canopy, and the client interface of TaxDome. When a firm owner looks at all of this, the ultimate fear driving their decision-making is pretty simple. Will I lose my clients if I don't adopt this technology?
Right. Will the firm that clings to the manual, traditional ways actually bleed out? The authoritative answer to that, based on the industry intelligence, is highly nuanced, but incredibly clear.
So is the robot going to steal my client?
No. You will not lose a client to a piece of software. A business owner is not going to wake up tomorrow, fire their CPA of 15 years, and hand their entire financial life, their tax liability, and their business strategy over to an AI chatbot. Clients buy trust. They buy the human relationship. They buy the psychological reassurance that a qualified professional who understands their specific business is watching their back. An algorithm cannot hold a client's hand and talk him off a ledge during a surprise IRS audit.
Okay, that is a relief. But
Another CPA firm that is using these tools absolutely will steal your clients.
wow, let's expand on that. Why? Because the client doesn't care what software you use. They don't know the difference between a Botkeeper and a spreadsheet.
They don't care about the software, but they deeply care about the output and the experience. Let's compare the operational reality of two firms. Firm A is traditional. They process everything manually. Firm B is AI-enabled. They use Dext, Botkeeper, Karbon, and TaxDome. When a client calls firm B on the 6th of the month with a complex, urgent question about whether they have the cash flow to make payroll next week, firm B can pull up the dashboard and answer in real time because their books are reconciled daily by the machine learning algorithms.
While firm A has to tell the client, let me get back to you next week after my junior accountant finishes the manual month-end close.
Exactly. Firm B turns around the end-of-month reporting in 3 days instead of 3 weeks. And crucially, they do it without burning out their staff. Firm B's team isn't working until midnight, which means their staff is happier, turnover is lower, and the client isn't dealing with the friction of a brand new, untrained junior accountant assigned to their file every 6 months.
And then there is the margin squeeze, which is where the blood is really drawn in a competitive market. If firm A is clinging to manual processes, they're fully exposed to those escalating staff costs we talked about at the beginning. To pay those high salaries for manual data entry, firm A must constantly raise their fees year over year just to maintain their baseline profitability.
While firm B has successfully decoupled their revenue from human hours, they are processing massive volumes of work at machine speed with a fixed software cost. This gives firm B lethal strategic choices. They can offer better, more competitive pricing to aggressively win market share from firm A. Or they can charge the exact same fee as firm A, but bundle in superior, forward-looking advisory meetings every single month because their staff actually has the bandwidth to provide them.
If you are a firm owner listening to this and you are currently struggling with client volume growth and deadline pressure, your client experience is already suffering, whether you admit it or not. You are returning emails a day slower. You are filing extensions at the last minute because you are buried in work. The quality of your interactions feels rushed. And that drop in the feeling of being taken care of, that friction, is exactly when a client starts quietly shopping around. They might not leave for the AI, but they will leave for the highly responsive, low-friction, high-value human experience that the AI enables firm B to provide.
So the threat isn't technological replacement. The threat is operational irrelevance.
Which means we need to talk about implementation. If you are listening to this and realizing you need to make a move, you cannot just go out tomorrow, buy all 7 of these tools and flip a switch. It would completely destroy your firm's culture and operations. We need a concrete, highly tactical action plan.
We must approach this based strictly on the firm size metrics and operational realities we've discussed. Change management is harder than software integration. Here is how you should prioritize this tech stack in 2025, ranked by the size of your firm.
Let's start with the solo CPAs. Just you, maybe an outsourced contractor during tax season, trying to survive the grind. Where do they start?
For the solo CPA, you must start exclusively with the data input and ecosystem tools. Do not look at complex workflow engines yet. Implement Intuit Assist if you are in that ecosystem, and deploy Dext immediately. These have the lowest barrier to entry. They require virtually zero staff training because, well, you are the only staff. They instantly solve the receipt chasing and basic data entry bottleneck, which is where a solo practitioner bleeds the most unbillable time. Get the raw data digitized automatically first.
Okay, what about the micro firms? Let's say firms with 2 to 9 staff. You have a small team, you are taking on new clients, but the foundation is starting to creak under the volume.
For the 2 to 9 staff firm, your focus must shift outward to client wrangling and then inward to core processing volume. Implement TaxDome first. Automating your client document collection, signatures, and basic reminders will instantly give your small team hours of their week back, and it establishes boundaries with your clients. Once your client interface is stable and frictionless, implement Botkeeper. This is the critical leap. Deploying Botkeeper allows you to handle the increasing bookkeeping and reconciliation volume without taking on the massive fixed cost and management risk of hiring that next manual junior accountant. You scale your software capability ahead of your payroll.
And finally, the mid-market players. The firms with 10 to 20 staff members, they already have tech stacks, but they are hitting a wall.
At 10 to 20 staff, you likely don't have a basic data entry problem anymore. You have a management and complexity bottleneck. The sheer number of moving parts is degrading your margins. You must implement Karbon, but only after you have audited and documented your internal SOPs. You need Karbon to get absolute visibility over your team's workflow and kill the internal email chaos. Simultaneously, if you handle accounts payable for mid-market clients, deploy Vic.ai to process that highly complex, high-volume AP work. It will strip out the manual matching process and allow your team to handle larger, more lucrative client accounts. That is a highly rational, phased roadmap. But as we wrap up this deep dive, I want to leave you, the listener, with one final, somewhat provocative thought. Something that wasn't explicitly debated in the software specs, but is really the logical conclusion of everything we've discussed today regarding the evaporation of the junior entry-level tasks.
The unintended consequence of total efficiency.
Exactly. Think back to the traditional ladder of the professional firm. We all agree the manual entry and the late-night VLO cups were miserable. But if these 7 tools are brilliantly, flawlessly successful at replacing the entry-level tasks of the junior accountant, how does the next generation of accountants actually learn the business?
It is a massive, looming blind spot for the profession.
I mean, if a young graduate comes out of university and never has to do the grueling 40-hour manual bank reconciliation, if they never have to hunt for the transposed 30 cents or decipher a messy ledger by hand, will they ever develop that deep, intuitive, almost subconscious understanding of how money actually moves through a business? The kind of battle-tested intuition required to eventually become a senior partner and offer high-level strategic advisory. The technology solves today's capacity problem, absolutely. It saves your margins today, but it might just create tomorrow's mentorship crisis. The algorithm can build the house, but someone still has to know why the house was built that way. Something for you to think about as you build your tech stack for 2025.